Through visualization, we have just seen how income and expenditure circulate across our economy. In this section, we will look at how we measure the level of national economic activity. Before delving into the primary issue, we must first study the definitions and principles of measuring economic activity. In actuality, measuring economic activity is significantly more sophisticated and complicated than what you learn in IB economics. Economic activity measurement entails calculating an economy's national income, or the value of output, sometimes known as the national income account. An economy's income, or output, is regarded as aggregate output, which signifies a nation's total output. The circular flow of income model suggests 3 GDP, or GNO measurement approaches, to calculate the value of total aggregate output, all of which yield the same outcome. 1. The expenditure approach, 2. The income approach, and 3. The output approach. First, we'll look at the expenditure approach to evaluate economic activity. The expenditure method totals all spending on final goods and services produced within a country over a certain time period. When we calculate the value of aggregate output, we only consider purchases of finished goods and services. Navigation and entertainment systems, for example, are intermediary goods for automobiles. Automobiles, in other words, are the finished goods. Total spending is divided into 4 components. 1. Consumption, denoted as C. 2. Investment, symbolized as I. 3. Government spending, indicated as G. And 4. Net export, which is export minus imports, or X minus M. When we add together the 4 components of spending, we get a measure of aggregate output, known as gross domestic product, or GDP. It is shown as GDP equals C plus I plus G plus X minus M. The income approach totals all revenue earned by a country's factors of production during a time period of 1 year. It is a normal practice that wages are earned by labor, rent is earned by land, interest is earned by capital, and profits are earned by entrepreneurship. National income is calculated by adding all factor incomes. While national income is frequently used to assess the level of economic activity, it is not the same as GDP. The output approach calculates the overall amount of output produced by measuring the value of each good and service produced in the economy over a given time period of 1 year. It covers the value of all final goods and services to avoid double counting caused by incorporating the values of intermediate goods and services.